We expect a total interest cut of 225 basis points, and that's inclusive of the 75 basis points that were already delivered by the Fed. And overall, the impact of rate decline on profitability will be negative for the GCC banks. And if you look at the numbers published by the rated banks, for every 100 basis point drop in the interest rate, there's a drop by around 9% in the net income. Obviously, that doesn't take into account any management action in terms of repositioning the balance sheet or in terms of changing the funding profile. And that's why we expect that the overall impact of the 225 basis point decline in interest rate will be around 25 to 50 basis point impact on the GCC banks margin, with the following variations. So for Bahrain, we expect 20 to 30 basis point. For Kuwait, we expect 30 to 50 basis point. For Oman, we expect 10 to 20 basis point. For Qatar, it could be plus or minus 10 basis point, and that's because of the dependence of the Qatari banks on the external funding. For Saudi, it will be between 20 and 30 basis point. And finally, it would be between 40 and 60 basis point for the UAE.
What does this mean for the lending growth, and especially for Saudi, which has witnessed, the Saudi banking sector have witnessed a high growth in their loan portfolio? Do you think that this will continue in 2025?
We project that the oil price will average 75 barrel over the next couple of years. And we think that with the implementation of Vision 2030, the overall growth for Saudi Arabia would be at around 4.3% on average between 2025 and 2027. And that would mean that the strong growth in the lending will continue. We project an overall lending growth of around 9% for the banking system in Saudi Arabia. That will be driven more by the corporate lending, because if you recall, in the last 3 to 5 years, the growth was mainly driven by the mortgages. Now, we think that with the implementation of Vision 2030 project, we will see more growth in the corporate lending space.
And how do you think this growth will be funded, given that the growth that we are seeing in deposits is not sufficient?
That's an excellent question, because as you rightly mentioned, so the growth in deposit has not been sufficient to fund the growth in lending. And what we've seen is that the Saudi banks went out and were looking to raise external funding. And that's why we project that overall the banking system will shift from a net external asset position to a net external debt position, but a very minor net external debt position. So we don't project a massive increase in the external debt. And we think that the Saudi banks will be resorting more and more to the international capital markets in order to fund this growth. And this is particularly also with the decline in interest rate and the expected improvement in the global liquidity on the liquidity on the global capital markets. We think that the Saudi banks will be tapping more aggressively the external funding.
And is this something that worries you?
As we stand today, no, because if you look at the overall debt position of the Saudi banking system, so we were in a net external asset position, we're going to be in a mild net external debt position. So up to a certain level, no. But if all of a sudden the Saudi banking system becomes very much dependent on external debt, we could see this as a potential source of risk for the system, because history shows that the external funding could be volatile in times of stress.
Doctor, let's discuss a bit the Qatari banking sector. We know that we have seen some challenges in the real estate sector due to the oversupply after the World Cup. So are you worried about certain negative repercussions on the banking sector in terms of debt restructuring?
Right. There is clearly an oversupply in the Qatari banking in Qatar on the real estate sector, and that was built in the run-up to the World Cup. Now, would that change the picture for the asset quality of the banking system? The expectation that it wouldn't. We would obviously see a little bit of formation of NPLs coming from the real estate sector, but we don't expect that this would have a significant impact on the financial profile of the Qatari banks. And we think that the decline in interest rate, together with the strong government support, will be helpful from that perspective.
So can you elaborate on the stress test?
Yes, absolutely. So we did a stress test on the 6 GCC countries' banking system on how the conflict in the Middle East could evolve and what could be the implication for the rating from modest to severe risk. And for modest and moderate, we expect no impact beyond our base case scenario. And we think we're currently in the moderate scenario with some element of high risk. And if you look at the definition of severe risk, you can see that under the scenario, we expect US, Iran, and the GCC to be dragged into the conflict with significant increase in oil price and risks to the trade route. Now, where it's going to hurt is on the asset quality side, because under our scenario, 13 out of the top 45 banks in the GCC would show losses in the high-risk scenario for $3.3 billion, and 25 out of the 45 banks for the severe risk scenario for a total amount close to $25 billion. But if you compare that with the net income of the top 45 banks and you annualize the numbers reported in the first half of this year, the banks have printed around $60 billion, which means that they can withstand the stress. And that partly explains the resilience of the banks in our view and our level of ratings in the region.